Do you ever feel like you're one step behind?
One step.
No matter how well you think you've timed the market, the price always seems to move in the opposite direction. Well, you're not alone. Every crypto investor has faced this at some point, but thankfully,
There is a solution.
on-chain analysis. On-chain data offers powerful insights into a project's momentum and potential, and this can be the difference between getting wrecked and getting rich. So today we'll tell you about 5 of the most important on-chain indicators you should be using to maximize your gains. My name is Nick, and if you want to max those gains, this is a video you can't afford to miss. Before we start, you need to know that I am not a financial advisor and nothing in this video should be taken as financial or investment advice. This is purely educational content designed to help you on your crypto quest. With that out of the way, let's begin. Before you YOLO into any crypto investment, it's crucial to gather all the available information. Those soaring green candles might suggest the asset is in a strong uptrend, but charts only tell part of the story. To make informed trading decisions, you need to look under the hood, specifically on-chain. One of the advantages of crypto is that transactions are publicly viewable on almost every blockchain, meaning you can see the flow of money between wallets and exchanges in real time. And this opens the door to some very powerful analysis tools. As you might have guessed, this data extraction is known as on-chain analysis. But if the charts are already telling you that a crypto is going to the moon, then why should you care? Well, put simply, on-chain data can quickly help you determine if the rally is legit or just smoke and mirrors. Now, I know what you're thinking. Sifting through the transaction history of every crypto I hold, that would take forever. Don't worry, you won't have to dig through all that data manually. There are plenty of indicators that transform raw blockchain data into insightful charts and tools, providing a bird's eye view of what's happening on-chain. Armed with this information, you can make more educated predictions about future price movements. So be sure to stick around until the end to see how you can combine these different analysis tools to really grow your crypto portfolio. So, if you're ready to take your investments to the next level, show it by decimating those like buttons down below, and don't forget to subscribe and ping the notification bell as well so you're sure you don't miss our next upload. Okay, the first on-chain indicator that you need to be familiar with is daily active addresses, and this can be found by using blockchain explorers such as Etherscan for Ethereum or SuiScan for, yep, you guessed it, Sui. Chances are that you're already familiar with blockchain explorers if you've ever had to check if your crypto transaction went through. But chances are that you've never taken the time to look through the analytics many of these explorers offer, such as daily active addresses. As the name would suggest, daily active addresses is the number of unique wallet addresses that have been active over a certain period of time. And this can include either sending or receiving funds. Each address can be traced back to either an individual user or a collective entity. But why is this important? Well, this metric gives you a sense of the activity levels of that network. In essence, it gives you an idea of the real-time demand of that coin or token, which often reveals much more information than simply looking at the charts. More often than not, there's a clear correlation between the number of active addresses and a crypto's price. More active addresses means there's more demand for that crypto, and more demand means that prices are likely to go up. On the flip side, a declining number of daily active addresses suggests that the demand for that crypto is falling and prices are likely to fall as well. And this alone is why watching the daily active address count is useful, but that's only half of the reason. There are other ways the indicator can give you an important insight into that crypto's future price action. For instance, if you see that prices are rising but the number of daily active addresses has stayed relatively flat, then more often than not, this signals that prices are actually being manipulated by whales. Naturally, these rallies are not sustainable and a price reversal could be imminent. Put differently, this could be a trap to draw in exit liquidity. And if you don't spot this soon enough, you could be the one left holding the bag. Conversely, if you see that a crypto's price is falling but the number of daily active addresses is rising, then this is actually a bullish signal. And that's because it signals that demand is rising, suggesting that a reversal to the upside could happen at any moment. And this could help you identify key opportunities to buy the dip, which could translate into some massive gains. And speaking of gains, if you want to maximize yours, then you have to check out the Coin Bureau deals page in the description. Over there, you'll get sign-up bonuses of up to $100,000 on the best exchanges, as well as 50% trading fee discounts and 75% cashbacks on deposits from said exchanges. You see, these deals are only available for the viewers of this channel and won't be around for long. So take advantage of it ASAP using the link down below. Back to the video. Now, the second on-chain indicator you should have on your radar is the total value locked, or TVL. And this is a metric used to determine the total value of digital assets locked or staked within a particular dApp or DeFi protocol. You can easily track TVL using DeFi analytics platforms like CoinGecko, DeFi Llama, or for Layer 2 solutions, L2Beat. And these platforms offer real-time updates, breaking down TVL by blockchain, protocol, and even by individual tokens, making it easier to spot trends and liquidity shifts. TVL is powerful because it reflects the amount of native liquidity within an ecosystem. However, it's important to note that TVL is often influenced by the token's price. So if the token's price drops, the TVL will also drop, even if the same number of tokens remain locked. And this is important because focusing only on dollar values can give a false impression of growth. Similarly, if the TVL in dollar terms drops, but the number of locked tokens remains the same, then this suggests that the problems are with the cryptocurrency and not with the protocol itself. And that's why it's best to pay attention to TVL in crypto terms and not just in dollar terms. So then, what should you look for with TVL? Well, ideally, you want to see TVL rising faster than the token's price, and this often indicates growing utilization and borrowing within the crypto ecosystem, especially in DeFi platforms, as signaling real native liquidity and strong demand. A good way to gauge this demand is by examining leading protocols noted on each blockchain. On the flip side, if TVL is declining while the token price holds steady or even rises, it could be a red flag that liquidity is leaving the protocol. And this might point to reduced levels of trust or capital moving to other projects. As liquidity drops, the token's price is likely to follow suit. In this sense, TVL is similar to the active addresses, but focusing on the amount of money flowing into a protocol rather than the amount of active users. It serves as a key indicator of the overall health and popularity of that protocol. Typically, a consistently high TVL suggests that the protocol is robust and stable, and this can in turn create a positive feedback loop as new users are attracted to the protocol, driving up the TVL, which attracts more users, and so on and so on. But it's not always that straightforward. A TVL can sometimes be artificially inflated by whales trying to draw attention to their platform. And this manipulation can, and often does, mislead investors into overestimating the security or popularity of that project. So, you should always cross-check TVL growth with the number of active wallets to verify its legitimacy. The third on-chain indicator you need to have on your radar is stablecoin supply. Now, like TVL, stablecoin supply is a crucial metric for understanding liquidity dynamics within a crypto ecosystem, and you can easily track it on platforms like DeFi Llama. Investors value this indicator because it provides the clearest view of how much liquidity is flowing into an ecosystem. In fact, stablecoin supply shares some similarities with active addresses in that it helps you spot divergences between a crypto project's fundamentals and its token price action. More importantly, analyzing stablecoin supply helps you determine how much of a platform's TVL comes from DeFi borrowing, since most borrowing in DeFi is done with stablecoins. And when stablecoin supply rises, it often signals increased capital injection into DeFi protocols, boosting liquidity and potentially driving prices higher. And by the way, we recently did do a video on DeFi borrowing and lending and how its growth could be bullish for the crypto market, and you can learn more about that right over here. Anywho, there's another metric you should be watching called the stablecoin supply ratio, which is the ratio between a cryptocurrency supply and the supply of stablecoins. In a nutshell, this provides insight into short-term buying power. A low stablecoin supply ratio means that there's a lot of stablecoin liquidity sitting on the sidelines, ready to be deployed into the market. And this suggests high buying power for stablecoins, potentially fueling a crypto rally, especially if that liquidity flows into the crypto project that you're watching. Conversely, a high stablecoin supply ratio means most stablecoins are already in use, leaving less liquidity available. And this suggests a weaker buying power and less potential capital flowing into the markets, making a sustained rally less likely. And something else worth keeping an eye on is when whales move stablecoins around, or when stablecoin issuers like Tether or Circle mint large amounts of stablecoins. And that's because large-scale minting happens when investors deposit large amounts of capital into the crypto market. And this foreshadows a sharp increase in trading activity. Thankfully, you can easily keep tabs on this by following Whale Alerts on Twitter or X. Now, Whale Alerts is basically a bot that automatically scans for this kind of activity. And you can find out what other Twitter or X accounts we recommend by checking out our video on that right over here. Okay, the fourth on-chain indicator that you need to be watching is exchange balances. And this metric tracks the total amount of a specific crypto that is held by exchanges and can be accessed on platforms like Glassnode, although accessing this requires a Tier 2 membership, which is a bit pricey. For crypto traders managing large amounts of crypto, though, the insights gained could justify the cost. Now, crypto held by exchanges typically falls into two categories: funds stored in hot wallets and those kept in cold storage. Hot wallets are online and accessible via the internet, making their funds accessible to anyone with access to the wallet's address. Cold storage, on the other hand, involves storing crypto on offline hardware or paper wallets, keeping funds inaccessible except when the exchange uses them for transactions. And this is important because when we look at crypto exchange balances, we typically consider the funds being kept in hot storage, and that's simply because these are the assets actively moving and impacting the market. The size of these balances will largely depend on how much trading activity is happening on that crypto exchange. Generally speaking, the higher the liquidity on crypto exchanges, the more active the market is, and vice versa. The reason this is important is because when exchange balances are lower, this means that there's less liquidity on these exchanges, which results in crypto prices being more volatile. Usually, this volatility is to the upside since less exchange balances mean that more investors are hodling, which implies more investors are bullish. On the flip side, when exchange balances are high, this is a bearish signal because it indicates that investors are sending crypto to exchanges, presumably to sell, at least in theory. In practice, there are other reasons why investors could be sending large amounts of crypto to exchanges. For instance, they could be looking to trade on the derivatives market, so thereby taking advantage of the market volatility, or they could be looking to utilize any staking mechanisms available on the exchange to earn a yield, or they're looking to participate in an airdrop campaign. Meanwhile, heavy outflows from exchanges indicate that investors are hodling, which is a bullish signal. Now, there is another thing you need to consider when you see whales sending large amounts of crypto to an exchange. You see, in the past, this often signaled an impending sell-off. However, whales have grown savvy to the market reactions, and now they use this visibility to their advantage. So, rather than selling immediately, an action that could trigger a panic selling and drive prices down, whales will often wait. They will let the market react, observing the initial sell-off and wait for the subsequent dip buying. They will then begin to gradually sell during the pump, allowing them to capitalize on the positive price action without disrupting it, maximizing their profits in the process. Okay, the fifth on-chain indicator that should be on your radar is the percentage of holders in profit. And this one is pretty straightforward and can be tracked on websites such as CryptoQuant, for example. As the name would suggest, this metric is a way to measure the amount of crypto folk sitting on gains at current prices. And this is arguably one of the most important things to consider during your on-chain analysis, because when nearly everyone's making money, it's only a matter of time before they cash in on those gains. So if you identify this trend happening, then the market could be overvalued and it may be a good time to sell. And of course, if it's the other way around and most investors are sitting on a loss, the market is probably undervalued and it may be a good time to buy. There are other metrics that you should also take into account when analyzing how many investors are in the green. For instance, there's the net unrealized profit to loss, more commonly known as the NUPL. And you can think of the NUPL as a way to check the temperature of the market. Basically, the NUPL indicator shows us the difference between how much an investor's crypto is currently worth versus how much they paid for it. When the Nupal indicator starts to get high, then this can often indicate that prices have become overheated and it may be a good idea to sell. Conversely, if Nupal is low, then the market is just getting warmed up and it may be a good time to buy. Tracking how many investors are currently in profit is a smart way to avoid emotional trading. For example, when you see endless green candles and all your technical indicators signal buy, it's easy to get caught up in the FOMO. But if nearly every holder is in profit, that's a sign that the rally won't last and you could avoid becoming exit liquidity. So then, now that you understand the 5 key on-chain indicators, the question now is, how can you use on-chain analysis more effectively? Well, as you've probably guessed, the answer lies in combining it with the other 2 forms of analysis, technical and fundamental. If you're unfamiliar, technical analysis involves studying cryptocurrency's price history to identify patterns and trends, aiming to predict future price movements. Fundamental analysis, on the other hand, dives into a project's fundamentals to determine its intrinsic value. And this means examining the team behind it, the technology, tokenomics, use cases, and so on and so on. Individually, these 3 types of analysis, technical, fundamental, and on-chain, are powerful tools. However, each only reveals a part of the bigger picture. To truly succeed in the crypto space, mastering all 3 is essential for making well-rounded, informed decisions. Fortunately, we have detailed guides on each of these analysis methods, which are linked to in the description, which I highly recommend you come back and watch later. But back to on-chain analysis. As you've seen throughout this video, it's a powerful tool for assessing a project's potential. But what if I told you that on-chain analysis can also help you uncover additional investment opportunities you might otherwise have overlooked? Take active wallets as an example. An increase in the active wallets is typically a bullish sign for a crypto project or protocol. But what protocol is driving that activity? Investigating this on-chain can reveal whether the token associated with the project fueling that growth is positioned to rally as activity ramps up. As for a platform's TVL, it's obviously great to see a project with lots of funds locked on-chain. But you can also look at bridged TVL, which basically tracks the amount of native liquidity that's been bridged between 1 or 2 ecosystems. Whichever crypto is receiving this bridged liquidity could see a spike in activity, and the price of its token could rally as a result. It's a similar idea with stablecoin supply. If the supply of stablecoins is spiking, then this usually is for a good reason, and identifying the cause of this could foreshadow an announcement of some kind. An announcement that your portfolio was prepared for because you followed the on-chain clues. And this approach also extends to exchange balances. A significant amount of crypto sitting on an exchange could foreshadow a major move. However, it's important to remember that holdings in ETFs can affect how these balances appear, so context is key. As for the percentage of holders in profit, this can be a great way to identify which cryptos you can invest in before it starts to pump. And that's because these profitable investors will likely rotate these gains elsewhere. For example, BTC holders would likely rotate into ETH. As you can see, on-chain analysis is a powerful yet underutilized tool. If you want to stay ahead of the game, integrating these indicators into your investment strategy is a simple yet effective way to gain an edge. Now, once you have that edge, you are going to want to know where Bitcoin is heading, and you can find out by watching our video right over here. And if you're not subscribed to the channel yet, you can do that right over here. That's me, Nick, signing off. Thank you guys very much for watching.